on the leasing side to give you a few insights into how we see things moving forward in the investment market. The market remains paralyzed. That's no news. And I think what is new is that in 2008, the paralysis was a function of a pricing gap. Buyers and sellers unable to agree on what the yield should be. As we get into 2009, we find sellers are ready to transact. However, buyers are opting for the sidelines because they believe that better opportunities lay down the road. Boston fared well economically and from a market standpoint longer into 2008 than most other places in the country, and as a result, we are not seeing the distress yet on the ground that are showing themselves in other regions. There are isolated incidents of distress that you read about in the press, but statistically we are not seeing, again, high levels of distress, but we believe more distress is coming. There are pockets of liquidity, and those areas include investments under $15 million that can be financed by those active banks that Dave referred to. Multifamily, as always, remains sellable. Medical office properties are becoming increasingly popular. And any smaller deals, office or industrial, that have long-term leases in place to get the investor through the uncertainty of the next few years are trading today. Many investors came into this year with the hopes that new allocations of debt money from the life insurance companies in particular was going to jumpstart the investment market this year. And as we've heard from Dave, allocations to date have been anemic. As you can see from this graph, 2008 volume across property type basically reflects where we were in 2003. Currently, there is only about $400 million of pending investments in the market across all asset classes. These are some of the high-profile properties you can read about. You know, the Hancock Tower, we believe, is on a grand scale an illustration of what happens when a perfectly good, intrinsically valuable real estate is over-levered. And as I think there are something like 8 lending entities that are currently battling for their interests, the outlook for the property is uncertain. Faneuil Hall Marketplace, which is owned by General Growth, is another property we've read about. It's currently on the market. General Growth is a publicly traded REIT that owns many great malls across the country. And like Broadway Partners, General Growth's problem is not about challenged real estate on the ground, it's about debt problems. General Growth's problem is that it's facing billions of dollars of short-term, of expiring debt into a market in which there is no opportunity for refinance. But there is a bright spot, and we need one. One Beacon Street, as Ron referred to, closed last week. Allianz, which is an investor out of Germany, invested somewhere around $100 million in equity to do a 50% joint venture with Beacon Capital Partners. Clearly, this is a testament to, or an indication of their confidence in the long-term viability of Boston's CBD. So as we go into this paralysis, the question becomes, how do we get out? And, you know, very simply, things either get better or things are going to get worse. And as much as we would love to cheerlead for some sunny resolution to the problem, it becomes clear to us that unless the market wrestles with the measures and then manages the potential distress, investment volume is not going to pick up. So as we look at an individual asset, a portfolio of assets, or frankly an entire market, these are the factors we consider to measure how much distress we have. What is the status of the existing debt on any piece of real estate? When does it expire? Can it be assumed? Is the existing debt an asset that can enhance pricing, or is it a liability that's forcing the sale? What is that particular property or portfolio's exposure to the eroding fundamentals that we've heard about today? And finally, what are the other portfolio problems that any particular owner or company might be facing that may trigger a hold versus sell decision? Now I'm going to walk you through where we believe each buyer sector is in today's market. The pension funds are, given their sheer size and the magnitude of their holdings, market makers, whether they want to or not. So when the pension funds step out of the market, their absence is dearly felt. There's much discussion today about the denominator effect, that as the stock portfolios declined in value, real estate became too large a percentage, i.e. over 10% of their total portfolio. We believe that most pension funds are not going to sell down to meet an allocation, but it will definitely hinder new investment. The countervailing factor today in the denominator effect is the fact that many pension funds are in fact writing down their real estate. The NCREIF numbers just came out for the fourth quarter of 2008, and it showed an 8% quarterly decline in value, which is the largest quarterly NCREIF decline since NCREIF has been around, which is 31 years. The other problem facing pension funds, and particularly open-ended funds, are redemptions, which is when investors are seeking a return on their capital. We believe that is the factor that's going to cause pension funds to sell real estate in 2009. Insurance companies like large commercial banks are basically treating their capital as a precious commodity they need to shore up their balance sheets and to protect their all-important ratings. Therefore, we don't believe you'll see insurance companies as equity players, and we're looking forward to them being active on the debt side. The foreign groups that bought feverishly because of a very cheap dollar are not there in a large degree, although I must say they remain interested, primarily from Western Europe and the Middle East, interested in investing in Boston because of the long-term fundamental health. Ever the opportunists, the private equity funds have raised much money. Unfortunately for private equity real estate, most of that money is going, as Dave had indicated, into alternative investments such as mezz loans, CMBS tranches, or loan purchases. Which brings us back to the traditional investors, traditional real estate investors, and there are innumerable numbers of folks scouring the market, hoping to buy great real estate at a discounted price. And two ingredients have, up until now, been missing, and that's willing sellers and a sufficient mortgage market. We believe that sellers are ready to transact, and what we now need is the capital flow on the debt side to facilitate the sales. The biggest challenge today is determining current pricing. There's been virtually no data to enable the buyer and seller to reach what we call a market clearing price. There's a painful back and forth that's taking place, but we believe through that struggle, sales will get consummated, and then we will see enough data to enable underwriting benchmarks that, frankly, all of the stakeholders in the process need. The buyers, the sellers, the lenders, the appraisers. But why sell today? Obviously, many sellers are opting to sit by the sidelines. However, some are feeling that if their asset does fit into that pocket of liquidity that I referred to, and they can sell at, albeit a higher price than they might have achieved a year ago, they are venturing into the market. Given the magnitude of the government stimulus, it seems inevitable that the capital is going to flow back into the commercial real estate investment market. The big challenge now is underwriting for the recession, and you've heard my partners talk about job loss. Until the job losses subside and then buyers can digest the impact that job loss has had on occupancy and rental rates, I think buyers will continue to underwrite for a downturn that, frankly, hasn't hit the numbers yet. In closing, as we advise our clients through this rocky market, we really see two paths. For the opportunists that are hoping to exploit